Ever wondered how a young boy from Omaha turned his $114.75 savings into a net worth of over $100 billion? Warren Buffett, often referred to as the Oracle of Omaha, isn't just one of the richest people in the world. He's also a master of simplicity when it comes to investing. But what sets Buffett apart isn't just his wealth. It's his unique approach to money and business that has stood the test of time. From studying stock charts as a teenager to redefining investment strategies in his 20s, Buffett's journey is nothing short of inspiring. Today, we'll uncover the secrets behind his iconic investment strategy, offering insights you can apply to your own financial journey. So how does Buffett do it? Let's dive in. The early lessons. Warren Buffett's investment journey began when he was just 11 years old. Armed with $114.75, he purchased 3 shares of a stock called City Service Preferred. While most kids his age were playing outside, Buffett was charting stock prices and reading technical analysis books. But as Buffett himself later admitted, his early approach was fundamentally flawed. At the time, he focused on predicting whether a stock's price would go up or down. He believed that successful investing was about timing the market, a common misconception many beginners share. For 8 years, Buffett followed this method, obsessing over charts and trends. It wasn't until he encountered Benjamin Graham's book, The Intelligent Investor, at the age of 19, that everything changed. Graham introduced Buffett to the concept of value investing, focusing on the intrinsic worth of a company rather than its short-term market movements. This lesson marked a turning point in Buffett's life, reshaping his philosophy forever. Buying businesses, not stocks. One of Buffett's core principles is this: when you buy a stock, think of it as buying a business. He doesn't see stocks as symbols on a screen. Instead, he views them as ownership stakes in companies with real employees, products, and customers. Buffett's transition from stock speculator to business owner came directly from Benjamin Graham's teachings. By adopting this mindset, Buffett no longer worried about daily stock price fluctuations. Instead, he focused on understanding the underlying business, its competitive advantages, management quality, and long-term growth potential. This perspective explains why Buffett isn't fazed by market volatility. He often says, "I don't know what the stock market will do tomorrow, next month, or even next year, but I know that great businesses will create value over the long run." For example, when Buffett invests in companies like Coca-Cola or Apple, he doesn't panic if their stock prices drop temporarily. Instead, he sees these moments as opportunities to buy more at a discount. Circle of competence. One of Buffett's most famous principles is the circle of competence. Simply put, it means sticking to industries and businesses you understand. Buffett once said, "You don't have to be an expert on every company. You only need to understand the ones you're investing in." By focusing on his circle of competence, Buffett avoids making uninformed decisions. While many investors got caught up in the hype, Buffett stayed true to his principles. And when the bubble burst, his discipline paid off. This lesson is especially relevant today. In a world full of complex investment options like cryptocurrencies, NFTs, and AI stocks, Buffett reminds us to focus on what we know and understand. Power of patience and long-term thinking. Patience is a hallmark of Buffett's investment strategy. He's often quoted saying, "The stock market is a device for transferring money from the impatient to the patient." Buffett's philosophy revolves around the idea that wealth is built over decades, not days. Unlike many investors who chase quick profits, Buffett takes a long-term approach. He doesn't buy stocks with the intention of selling them quickly. Instead, he holds onto businesses for years, sometimes even decades. Take Coca-Cola, for example. Buffett began investing in the company in 1988, and over 35 years later, it remains one of Berkshire Hathaway's largest holdings. Why? Because Coca-Cola continues to generate consistent profits and has a strong global brand. This approach contrasts sharply with the short-term mindset of many modern investors who panic during market downturns. Buffett views such downturns as opportunities to buy more. In his words, "Be fearful when others are greedy, and be greedy when others are fearful." Margin of safety. One of the core principles Buffett learned from Benjamin Graham is the concept of a margin of safety. This means investing in businesses at a price below their intrinsic value, creating a buffer against potential losses. Imagine you're buying a house worth $500,000. If you can purchase it for $400,000, you have a $100,000 margin of safety. Similarly, when Buffett invests in a company, he looks for opportunities where the market has undervalued its true worth. By adhering to this principle, Buffett minimizes risk while maximizing potential rewards. It's a strategy that has helped him weather countless market crashes and economic downturns throughout his career. Snowball effect. Buffett often describes investing as a snowball rolling down a hill. As the snowball gains momentum, it grows larger and larger. This analogy highlights the power of compound interest, a principle Buffett has relied on since his earliest investments. For example, instead of withdrawing profits from his investments, Buffett reinvests them, allowing his portfolio to grow exponentially over time. This strategy has enabled him to achieve extraordinary returns. To illustrate the power of compounding, consider this. If you invest $10,000 today at an annual return of 10%, it will grow to over $67,000 in 20 years. The longer you let your investments compound, the greater the results. Buffett's advice? Start early, be consistent, and let time do the heavy lifting. Passion and people. Beyond financial principles, Buffett emphasizes the importance of loving what you do and surrounding yourself with the right people. He credits much of his success to his passion for investing and his ability to stay focused on it for decades. As Buffett once said, to succeed, you need to find your passion and stick to it. By doing what you love, you'll have the motivation to persevere even during tough times. Additionally, Buffett surrounds himself with individuals who bring out the best in him. He values trust, loyalty, and long-term relationships, whether it's with his business partners, employees, or shareholders. This focus on relationships extends to Berkshire Hathaway, where Buffett has built a culture of trust and integrity. Warren Buffett's investment strategy isn't about chasing trends or trying to predict the next big thing. Instead, it's rooted in timeless principles, understanding the businesses you invest in, thinking long-term, and staying disciplined. While the financial world can often seem overwhelming, Buffett's approach reminds us that success doesn't require genius, just patience, consistency, and the right mindset. So whether you're a seasoned investor or just starting out, take a page from the Oracle of Omaha's playbook. Focus on the fundamentals, trust the power of compounding, and remember, it's not about timing the market, but time in the market. Thanks for tuning in to Keep Existing. Financial Future Hub. Warren Buffett's investment strategy is a masterclass in patience, discipline, and understanding value. His principles remind us that the journey to financial success requires clarity, focus, and a long-term mindset. Are you ready to apply these lessons to your own financial journey? Let us know in the comments. Don't forget to like, subscribe, and hit that notification bell for more insights into building your financial future. See you in the next video.